a partner at Cooper Parry in our wealth management team. And today I'm going to talk to you a bit about inflation, interest rates, investments, and actually what does it mean for your financial planning. So it's fair to say there's been quite a lot going on in the world the last few years. We've seen inflation skyrocket to double digits and then start to fall back a bit. And obviously on the back of that, we've seen a rapid rise in interest rates. And obviously this has had a massive impact on the economy, your businesses, and then also personally as well. I know if anybody's renewed their mortgage in the last couple of years or is nervously waiting over the next 12 months, it's certainly quite a scary position to be in. You know, we're also not out of the woods kind of globally in terms of the impact of the global pandemic. You know, it wasn't that long ago that China was still in lockdown. We have a massive amount of global debt and a potential future of higher taxes. And of course, we've still got 2 wars going on in the world. Who'd have thought that in 2024? It's amazing how that news can be front page and then filter away to the back pages. And of course, if you haven't noticed, we've got 2 upcoming elections this year here in the UK and in the US. So when you think about all of this, when it comes to your own finances, you know, it's no wonder you might be feeling a bit like Kevin McAllister. And, you know, during times like this, or when we talk about topics like I've just covered there, you know, this is when we start to see a few predictions coming out. And here's one from 2016. This was a headline in The Guardian from RBS's chief economist. Now let's just go back to 2016. What was happening? We had Brexit and we had the threat of Donald Trump becoming president in the US, and we all know how that panned out. So what was the headline? That was sell everything and get out of the stock market ahead of a crash. And actually the advice here was to move to bonds and oil, because what was being predicted was that we were going to be back in the worst year since the financial crisis and back in recession. Let's see how that panned out. So this is the global stock market. Here you can see the general rise in the chart. And actually, if you'd taken that advice from that headline, you'd have missed out on 30% growth. Now, just to be clear, from a risk perspective, you know, there's probably a few of you thinking that Donald Trump is going to be back in the hot seat later this year. This is not Ewan at Cooper Parry telling you that there is going to be a stock market rally on the back of Donald Trump becoming president again, okay? Let's make that very clear. Nobody can predict stock market movements in the short term. But actually, the message that I'm saying is maybe things aren't always as bad from an investment perspective than what the headlines will tell you. Now, thinking specifically about elections, and the same rings true in the UK, actually elections don't have a massive impact on stock markets when you keep a long-term view. You know, this is a chart that shows, you know, a raft of different presidents from history, whether it's Republican or Democrats. Fair to say that the general trend of the S&P 500 has been upwards. And this is the same when we look at the global stock market as well. You know, here's a chart from 1970 through to the end of 2023 that shows if you'd invested £1, it would be worth £186 today. You know, that is massive percentage growth over the long term. So whether it's interest rates, inflation, wars, financial crisis, tech bubbles, actually the stock market has proven to be extremely resilient and a very good mechanism for providing returns to long-term investors. So what's the message from me? Don't know what's happened to that slide. It's control your emotions and think long-term. You know, actually, when it comes to it, humans are not wired to be good, successful investors. Now, at Cooper Parry, we like to be quite academically driven when we form our investment beliefs and how we go about managing money. You know, a really good source of information is JP Morgan's Guide to Markets. And what we have here is a 20-year study that looks at the success of an average investor. Now, to be clear on the definition of average investor, this is not an advised investor. This is somebody who does it themselves, and it's picked up from a research agency called Dalbar. And ultimately, what it shows on a 20-year basis is that the average investor has left an awful lot of return on the table when we look at the various types of asset classes that you can invest in, whether that's bonds, whether that's property, whether that's equities, or whether that's a blend of all those different types of investment. So we have to start asking ourselves a question, well why is that? Why does the average investor fare so badly? Well, the media has a huge role to play in this. I was at a conference a number of years ago where the person speaking actually held up the Evening Standard, and the FTSE had fallen by something like 12%, and it was making front page news. Actually, a couple of days later, the FTSE had recovered by 11%, and it was hidden back in the back pages. Negativity sells, it's what creates clicks. Positive, good news is not going to make front page media. And I'm talking about an old world source here, I'm talking about newspapers. Actually, it's an awful lot worse today when we think about the mediums of where we get our information from. Whether your poison is Instagram, Twitter, or Facebook, we've never had such regular and quick access to new information. The scary thing, and it's probably even worse for our children rather than the people in this room, these are the sources of where people go to when they want to get a question answered or look to research something that they have no knowledge in. Now, if you think about that from an investment perspective, think about it, somebody who might act on a great investment tip or a stock tip, a company to buy. Humans are inherently quite greedy. If that tip was so good, why would you put it out on a platform for millions of people to benefit from? Actually what you would do is keep that information for yourself and go and make that trade or purchase to capitalise on it. You wouldn't share it so widely. So then you have to start questions, well, what's the motivations behind sharing that information? And actually, a lot of the time, the information that's presented, we don't even know what the source is or indeed how accurate it is. And when we think about it, and you think about the sort of unadvised investor, this is a model how most people will go about it. And I'm going to use cryptocurrency as a bit of an example here. And I would argue that most people, or sort of the average do-it-themselves investor who might think about a dabble in cryptocurrency, has no idea what they're doing, or indeed what cryptocurrency is. So they're approaching it with some sort of doubt and caution because they don't have that knowledge. And in general, it's not really surprising when we think, well, we're not educating in investing whatsoever. But actually, they've seen huge returns being presented on social media, some sponsored ad that's telling them to invest through this platform. They're seeing massive returns that are being posted. So actually, they think, well, I want a bit of that, and I'll approach it with a bit of confidence, and I'm going to buy that asset. Now, we know in most investment markets, it's not always an easy ride. Things do not go up all the time. And depending on the type of thing that you can invest in, it can be quite volatile. And again, linking back to my example on cryptocurrency, there has been some very volatile times in those markets. So all of a sudden, your enthusiasm and a nice happy return turns to massive indifference and concern when you see that value drop. And because somebody doesn't realise what they're doing, they begin to panic and think, oh my God, I can't lose any more money, time to sell out and cut my losses. And actually, if you follow that pattern of behaviour, it's a quick way to lose an awful lot of money really, really fast. Now, I'm using an example of cryptocurrency there. We see the same behaviour in stock markets. And again, I'm going to refer to a chart from JP Morgan's Guide to Markets. And let me just take 10 seconds to explain this chart because I'm conscious it is extremely busy. Now, this is a chart showing the S&P 500, the American stock market. Here you can see this grey line showing the growth since 1995, broadly to the end of 2023 when we're up towards 5,000. Now, you'll note these blue areas. Above the line is where people are buying into the S&P 500. Below the line is where people are selling out. So if we concentrate on sort of the run-up to COVID here, you can see the sentiment around the American markets was pretty poor, and we were seeing outflows from the S&P 500. But notice the market was still going up in value. Here, this is the COVID impact, and obviously that had a massive shock around the world in most markets. But then you can see what that led to in terms of investor sentiment. We saw a huge amount of outflows from the market. Notice what the market is doing. We had a big rebound, and clearly investment to sentiment didn't return until halfway through that rebound. And that's only when people started to buy back in. all of this return had been missed by investors. Think about that again, when we kind of hit the interest rate and inflation issues, we saw a big dip in value, investors ran away from the markets, and they've missed the big upturns that we've seen of late. So putting this chart into context, and refer back to the asset class chart that I showed before, when you think about this methodology, you can understand why the average investor doesn't fare very well. They are too short-termism, they try to make emotional decisions, and it doesn't fare very well. Now, what we know from looking at a history of markets is actually the biggest returns come from the shortest periods of time, and that's why it's really, really important to stay invested over the long term. This is another study that shows the American market over a 20-year period. And had you just invested $1,000 and done nothing, your $1,000 would have turned into $26,000. Missed the best one performing day of the market, that would have turned into $23,000. Missed the best 5 days, $16,000. Missed the best 15 days, $9,000. And missed the best 25 days, $5,000. So let's just recap on that. If you'd done nothing, you'd have returned or turned $1,000 into $26,000. If you'd missed the best 25 days of the market in a 20-year period, you'd have been sat there with $5,000. Clearly there is a message in terms of keeping long term and not trying to time when to go in and out of markets. So actually, how can you ensure your future investment success and make sure you maximise your financial planning? Well, at Cooper Parry, we think there's 6 principles to stick by. Firstly, that's exactly the stock market. It's tough to beat. As I just said, trying to time when to go in and out of markets or pick individual companies is gambling and not investing. And it has proven not to be the best way to manage money for investors. Understand risk and return are related. Frankly, if something is too good to be true, it is. Those bonds that you see advertised that will pay you 10% a year for 3 years guaranteed, well, it's usually set up on some Ponzi scheme or some illiquid property underwriting scheme underneath it. It is not as what is presented. Don't put all of your eggs in one basket. Diversification is an investor's best friend. Spread the risk as much as possible. Focus on the investment mix. Actually, if you go through a thorough financial planning exercise and think about what you want to achieve in the future, you can understand the types of returns that you need to achieve that. And once you know the returns you need from your money, you can think about how to structure your investments in terms of what you invest in bonds, property, equities, cash, other asset classes, because ultimately that's what controls the volatility of your investments. Keep your investment costs low. There is some crazy expensive stuff out there. You don't need it. Often complexity isn't needed and simplicity is what we're going to take you forward. And finally, as we've talked a lot about today, control your emotions and think long term. If you can stick to these 6 principles, actually you can concentrate on the things that you value, the things that you want to achieve in the future, and you don't have to worry about your investments. That's it from me today. Obviously, I've talked a bit about what to do with your money. I'm sure there's many business owners in the room. So Andy Parker is up next to talk to you about how you get value from your business. Thank you, and I'll be back later in case you've got any questions or want to chat over a drink. Thank you very much.